Joining us now is David Kudla. He's founder, CEO, and chief investment strategist over at Mainstay Capital Management. And he joins us now. David, is this going to be another quarter of stocks outperforming bonds?
I think it will be. I think that stocks are in rally mode. We're almost in a melt-up situation. The increase we've had in 2024 alone, the increase we've had now over the past 5 months has just been incredible. And the problem for bonds is that we keep, we talked about 6 or 7 Fed rate cuts just a few months ago. We're down to 2 or 3. Maybe 1, they're getting moved out. They were March, got moved out to June, moving out as far as September. We may not see a rate cut this year. So that's problematic for bonds, obviously. And we've seen what the 10-year and the rest of bonds have done because of that. What we've done, where you do have opportunity in bonds, though, for your portfolio, for someone in a 60-40 portfolio that need that bond allocation, stay ultra short on ultra short-term bonds, so you have very little duration, very little interest rate sensitivity, but we have these high yields we're still getting with rates being this high. So that is an attractive part of the yield curve for a bond allocation. But stocks, I think, continue to be on roll. We are due for a pullback at any time here of 4 or 5%. We've gone so long without as much as a 2% pullback in a day and any meaningful pullback. But we're still very constructive on stocks and constructive relative to bonds.
So, David, where are we in terms of valuation here? How do you think about the valuations in the equity markets if, maybe we're in this melt up kind of mode?
Yeah, so we're getting a little rich. We're at 20.9 is, let's call it 21, forward priced earnings on the S&P 500. The 5-year average is around 19. So we're a little bit rich, not as rich as we've seen in the past. And, there's a lot of people referring to this as a bubble. And I think that people that think we're in a bubble for stocks haven't studied a lot of bubbles to know, what that really means. When we look at the fundamentals, we have some of these growth stocks and the mega tech stocks trading at higher PEs than 20s and 30s, but they deserve it, right? And so, we think that we can still, and you never want to make a market call based on valuation, right? Stocks can stay undervalued or overvalued for a very, very long time. So while they're starting to get a little bit stretched, that's not a big concern for us because I think the fundamentals are still there to support it.
So based on that, though, I guess, because you're right, like it can always still go higher, even if it's overvalued, right? For the equity market, for example. But do you need to also rotate? So maybe you're not going to sell the Mag 7, for example, or sell NVIDIA, but do you need to rotate into more cyclicals? And or quality? What does that wind up looking like?
Right. So, what we favor right now, our overall investment strategy can be summed up very easy: large over small, growth over value, the U.S. over foreign. Outside of the U.S., we also like Japan. But the key here in diversification is, we're seeing industrials, financials, some of the other areas starting to perform better. We're seeing more breadth in the market, but we would stay with mega cap tech, the power of generative AI. They just announced healthcare assistants, basically, that do the work of a nurse. It's going to enter so much of our lives in the professional workplace, be transformational. So we've narrowed our Magnificent Seven down to our own Fab Four. We took out Apple, Google, and Tesla, and though that fabulous four is up, 38% this year, and really it's become, surprisingly enough, somewhat of a safety trade to go to these stocks when rates are going higher. They don't care about interest rates. They have plenty of free cash flow to fund operations and their research and development. So it remains to be a good core of the portfolio, but there's some other places you can look out. We'd avoid small caps until we know rates are coming down, also with cyclicals. Mid caps, though, we've increased our exposure to, is an area, the in-betweeners that they've grown out of the small cap camp, not the large cap yet, but mid caps have also started to shine as well.
Other sectors, David, besides some of those technology names, we've heard some folks talk about healthcare, some folks talk about financials. Either of those get your attention?
Yeah, financials, healthcare, industrials, especially, we think it makes sense to, we want to have a diversified portfolio. We are overweight tech. It's our highest weighting by far, or IT and communications. But we do think that as rates start to come down, when the yield curve finally gets back to looking like something normal, that will be very helpful for financials. And we'll see industrials can do well. When we look towards this year, we're not looking for recession, and we think we could have a soft landing, but we think it's more about a no landing. It's more that we'll have a slowdown and reaccelerate. We've got GDP was just revised for the fourth quarter to 3.4%. The economy's strong, labor remains strong. There's some indicators out there with the level of bankruptcies, credit card debt, credit card interest rates, what's happening in housing. There's some worrisome areas, but the economy just keeps chugging along.
David,
here.
Wouldn't that scenario, though, be good for industrials, materials, energy, like those sectors?
Yeah. And we're seeing there's some other reasons in energy. There always are, geopolitical risk premium and so forth. We've seen what oil's been doing. We've seen what cocoa's been doing. I think
it's high. It's very high.
Yes,
it's very expensive.
Yeah, everybody having a lot of fun with that one. Maybe needing to avoid as much. Maybe not the chocolate Easter egg this year, but there are commodities doing better, and actually, the cocoa story is just incredible. But we think that materials. With a more normal yield curve, financials, healthcare, certainly, that's a large sector for us as well.
All right, David, thank you so much for joining us. David Kudla, he's the founder, chief executive officer, and chief investment officer for Mainstay Capital Management. Troy, Michigan is where he hails from, so we got him via Zoom there. So some good stuff there. Always appreciate getting his calls there. He has a very strong social media game. I mean, it's all over my social when we have him on, so that's kind of cool.